Ladies and gentlemen, it's a great pleasure to be here. I was wondering why Tassia chose me, so I work for Coutts UK, an investment manager, wealth manager, hopefully some of you will be familiar with. I think part of the reason is that we are maybe one of the few that have a few Russian investments in our multi-asset fund. She lays it on to me, so I will talk a little bit about that and why we have a few Russian investments in our multi-asset funds, which are sold to, of course, UK-based investors, dollar-based investors, euro-based investors as well. So I'm going to talk a little bit about the economy, and I was quite nervous because I noticed Tassia said talk about oil, and get oil. I only know one hedge fund manager who's got oil right. No one's got oil right, and nevertheless, there is an investment we have in oil which I think you might find interesting. But more generally on the forecasting part, anyone here heard of Yogi Berra, the great baseball coach? He had some great quotes about forecasting. He said, forecasting, this is about trying to get baseball matches right, trying to forecast them. He said, forecasting is very difficult, especially about the future. And more subtly, which I think really is our world, and I go into this, he says, the future ain't what it used to be. These are his wonderful quotes that he put when he was trying to talk about when his team lost. But a bit of economics, and I'm sorry, some pretty difficult graphs to start with. There's the first really difficult looking graph, but important, because the future ain't what it used to be. And I'll tell you why. So the question we have is, why don't we have any inflation? We have quantitative easing, so in the UK, US, now in the euro area, and of course in Japan, we have governments doing Zimbabwe-type policies, spending billions and billions of pounds buying government bonds. In the UK, it was 375 billion. So why don't we have inflation? The yellow line there is UK inflation, UK RPI. But what I want you to draw attention to, don't worry, I know I work for Coutts, but I think this is the only UK graph we have. We're going to go on globally. What I wanted to draw attention to, have a look at the grey line. The grey line is bank lending since 1984. This is strange. The first time we've had negative bank lending for several years. This tells you something is very, very different about the world. I'm sure you won't be surprised to hear that in Euroland, bank lending is also negative. What about the United States? Well, the United States, we've got data going back to 1950. So think of the economic cycles we've had since 1950. The 1974 oil crisis, etc., etc. Never before did we have negative bank lending. So something really is quite different, so-called deleveraging. Encouragingly, in the United States, it seems like we've come through it. You can see bank lending has turned firmly positive. They seem to have come through. But what does this mean for us? What this means for us is it is a different environment, and it means in terms of interest rates, yes, we expect US interest rates to go up sometime this year, maybe UK interest rates, but when they do go up, it's going to be a much, much lower. If you're waiting for 5% interest rates in the US, you're just not going to see it. 2 to 2.5 is going to be enough. And just give a flavour of this, you're seeing, for example, this is just where does the market expect rates to go. So you can see that I've just got two lines, one a year ago, roughly a year ago, and now currently. And you can see rate expectations are coming down and coming down and coming down. Essentially the message here is, especially if you're a bond investor, and especially for many clients of Coutts, we sit on over $30 billion of cash for our wealthy clients, waiting generally for higher rates. They're not going to come. 2.5% maximum. So that's all I wanted to say about the economy. It is different this time because we have deleveraging. Of course, we've had recessions before, but look at that data. I'll just flick back to the United States since 1950 on bank lending. For bank lending to go negative for the first time and still be negative in the UK and still be negative in Euroland, very hard to have inflation, even with printing money. Okay, what about how should you invest? Some difficult graphs, some more difficult graphs. But some of you may have heard of risk on, risk off. What does that mean? So risk on means generally you should take risk. Risk off means you need to be maybe in high quality US Treasuries, government bonds. We've got an indicator here for risk on, risk off. Very, very simple. Focusing on what's the risk of a recession? Where's investor sentiment? That's very important. If everyone's too bullish, that can be negative. If everyone's too negative, actually that can be a bullish indicator. Growth and some kind of indicator of where credit spreads are. The good news is, on our measure, it's right to be risk on. It's right to put money in the markets. What kind of markets we'll come into. Just to delve a bit deeper, what is the risk of losing money on equities? Two risks. You buy a ridiculously high price, like in 1999 would be one example. Second risk is a recession. Because in a recession, you can see here, in a recession, you have negative returns, on average circa minus 11% returns in a recession. In contrast, you get positive returns in non-recessions. And this is a subtlety for those of you who invest in terms of markets, is that non-technical term, but equity returns tend to be lumpy. So about 1/3 of the time the markets are down, and then 60% of the time the market's up more than 10%. So very, very hard to time, but definitively if you can avoid a recession, fairly good. What do we use? US PMIs, still well above 50, so no problem. And the US has a model on recessions as well. So no recession in sight for the US. That's not the issue with the US. The issue with the US is how expensive is this market? Okay, let's have a look now at various asset classes and just see where the value is. So here's just one measure. This is before the financial crisis and now. So where yields were, yields on fixed income, equities, commercial property, in 2007 and now. One measure. We'll have more detail in a moment. First thing you will notice is that cash and, of course, government bonds have dissipated away to very, very low yields. You can still find reasonable yields and high yield in EM. And coming back to Russia, what do we have in our portfolio? We do allocate money to high-quality Russian dollar corporates. Where can you find value? You can find Sberbank, Gazprom, VTB, etc., at yields in excess of 7 and in close to 8%. So there is, in our essence, a measure of value. I think what is interesting here is, if you look on the right-hand side, you can see the bars are slightly higher. So despite the rally in equity markets that we've seen, at least compared to before the financial crisis, yields are somewhat higher. Also on commercial property. This is UK commercial property, it's certainly not London. London commercial property, especially West End, is red hot. In Bond Street in the West End, you'd be lucky to find a place for 2%, a 2% yield. We have many customers of Coutts who are willing to buy that kind of investment, if you like the new gold, rock solid investment with strong rental growth but very, very low yields. This is UK nationwide. Okay. Some more valuation, this time looking at much longer history. So on the left-hand side, towards the bottom is bad. What this means is, compared to where you were able to invest over the last 20 to 30 years, you're getting very low yields on cash, we know that, but also, unfortunately, in terms of fixed income, the premium, the extra yield in corporates, high yield, EM, is relatively low. Of course, there's EM and there's EM. Happily, Russian EM trades relatively cheap right now. In contrast, on the right-hand side, low is good. Right-hand side is equities. And what we're looking at here is, instead of current PEs, I know we've got a lot of experienced investors in the audience, we're looking at Kate PEs or Schiller PEs. So this is looking at a 10-year average, so it tries to smooth out the recession. So an example of that would be in Russia, when you have a recession, of course earnings are going to fall. But the market looks through that and wants to look at an average level of earnings, so 10 years. You can see the US looks somewhat elevated, but there's good value to be had in Europe and the UK. And Japan, well, it's a lot cheaper than it used to be. A lot cheaper, although at 23 times earnings. So the message here is, where's the value in equities? Looking at a bit more in detail. So what we've got here is a graph of this cyclically adjusted price earnings ratio. And you can see here the big difference between US. Okay, we're not at 1999 peaks when PE ratios are crazy, when the NASDAQ top 10 PEs were averaging circa 70. The good news today about the US, although it's an expensive market, it is not quite ridiculous, it's just expensive. But look at performance year to date. All the performance is coming from Europe, the cheap markets. I should add, Russia looks incredibly cheap on this kind of metrics. It's on a Schiller PE about 4 or 5. And that's why in our multi-asset portfolios we have a very small exposure to Russian equities. Or one of the reasons why. So basic message is, again, Europe is where it is. Europe is where we're are seeing some signs of economic recovery, but Europe is where the value is. US, somewhat expensive, but not as expensive as 1999. Okay, so I was asked to come up with something in oil. And I think what you may find interesting is this is a measure of oil intensity. How important is oil in major economies today? And this is in Europe. And basically it shows, as I'm sure you'd understand, as our economy's developed, more service side, more technology, the fact is that certainly a country like Europe is much less oil intensive than it used to be. So what we've got here is stimulus on the lower ground, drag on the higher ground, and you can see that it is a stimulus to Europe, as you'd expect, but a modest stimulus. Simply less industrial economy, less oil-intensive economy than it used to be. Okay, hopefully you'll get these slides, so you'll get the words, the very difficult words, because at the back I'm sure you won't be able to see much. But where have we invested in something which is oil-related? Well, clearly we invest in Russia, which is oil-correlated in terms of the dollar-denominated bonds, and a very small portion in equities. The other area we like is master limited partnerships, so-called MLPs. I don't know if you're familiar with it. These are literally the pipes, the infrastructure. So what US companies have done for many, many years is they've sold off the pipes, a bit like real estate investment trusts. And basically, if you own the pipes, you get the cash flows. The good news is that the yield is high. The yield is about 7%. The bad news is that there has some kind of correlation with oil, as you expect. But I'd like you to look at this difficult graph if you can. What is the yellow? The yellow is what's happened to dividends in the US, general dividends. So in the financial crisis, dividends took a hit, just like the market. So dividends fell 20%. You may remember what happened to oil in 2009 and also the high yield market. I should add that these master limited partnerships depend a lot on high yield financing as well. So there is a high yield element to this. But have a look at distributions or dividends. This we find very, very interesting. MLPs held up well. The reason is they're not so related to the oil price. They're based on volumes, and a lot of the contracts are so-called take or pay, so they have to pay. So this is strong evidence from our perspective that this oil infrastructure play in the States is a lot less correlated to oil. Look at 2009, distributions held up. And early days, I'm looking at this very, very carefully, early days indicate that distributions are still increasing. So think about this, you're getting a 7% yield and an increasing yield. So unlike fixed income where it's fixed, it's increased. So we think MLPs are attractive, and we have those also in portfolios. Okay, maybe a little more controversially, but also another reason why we invested in Russia, and generally while we try to be contrarian investors, is that when you look at geopolitical events, it's all over the news. It's all over CNBC, Bloomberg, etc., etc. I should know I go on CNBC, Bloomberg, and they're asking me to comment on these things, and you kind of have to come up with some kind of comment to fit the story. But when you look at the investment case, and I'm sure many of you will know this, generally, when you look back over 3 years, it's been right to buy into crisis. whatever the crisis year. This is actually taken from the Coutts 2015 Outlook, and it's various, so we say, geopolitical events, and it shows the return from investing in geopolitical events. Some of it is just S&P 500 returns. Some of it is the local emerging market where we can get it. But you can, if you're interested in this, and we refer to MLPs as well, on the Coutts website, the 2015 Outlook is free to download. So I'm really, just to sum up, what are the numbers on this? It's very simple, and we know this, but it's very scary. When you're in a crisis, markets fall. So kind of on average 17%. Obviously in dollar terms, the Russian equity market fell a lot more than that, and even the dollar bonds. I think we saw yields on Gazprom at as close to 9.5% at one stage. Now down more like 7% in dollar terms. So you fall off quite rapidly. But generally, if you buy into crisis, and this is more equities, you tend to do well. And there was a famous British-French, I would say, financier, Rothschilds. He's got a very famous quote, which is going back centuries even, which is buy on the sound of cannons, which means essentially buy, if there's a war, you buy into terms of geopolitical risk. So I'll stop there. So hopefully that's given you an insight to how we invest. I should say, in terms of our multi-asset funds, I've talked about a few untraditional investments. Of course, we have traditional US equities, European equities, US bonds, etc. But I think these are the more interesting aspects. So if there's one message I'd like you to take away from an economics perspective, remember that bank lending. You know, it's rare when people say, well, this time is different. Well, it really is different. This negative bank lending, we haven't seen it. Remember, the US went all the way back to 1950. The UK went back 30 years. Negative bank lending. So either banks are not willing to lend, or companies, consumers are deleveraging. Very important message there on rates. And then secondly, where's the value? The value for us is more in equity, commercial property related assets, and generally into the next geopolitical event, hopefully you will see Coutts buy into that if we're consistent with our investment philosophy. So with that, I'll hand over to Helen.
Thank you, Alan. It was great. Thank you.